Greetings, and thanks for joining us for another episode of Lightbulb Moments. This will actually be a special session to go through the 2025 P&L study. I do have a guest joining me in just a moment, which I will welcome to the mic and the screen. That's Jared Sanders, CPA, who has been key partner in this study. Thanks for joining us, whether you're joining us live on Wednesdays on every other Wednesday at 10 a.m. Central Time, or listening to the podcast or viewing the YouTube. We're glad you're with us. Thanks for spending your precious attention and time with us today. I do want to give a shout out to Lightheart Sanders, who has been a sponsor of this forum for many, many moons, perhaps from the very beginning. So thanks to them. So let me actually welcome Jared. Jared, why don't you come to the screen and we'll have you turn on the mic. Good morning. How are you today?
Doing great. How are you doing, Tom?
I'm doing good, thank you. Well, thank you for all your hard work and the collaboration in helping to pull off what is a very difficult task, and that is to in a very professional, secure, and well thought out way, collect actual P&L statements from a variety of different salons and spas, and address all of the inconsistencies in financial reporting and all of that to come up with some meaningful findings. And I'm glad we're at this milestone. So again, Jared, thanks for all your hard work.
I appreciate it. It's been a fun project, but it is exciting to start to look at some of the details.
So we've shared some of these findings in different forums. We've done it in certain presentations, but we're really at the point where we're moving into final report writing. And heads up to those that are participating and listening in today, whether live or recording. So this particular presentation today is for a wider audience because part of the reason that we do this P&L study is not just for the benefit of the participants, but it's also for the industry, because we all believe that better data results in better decisions and better outcomes. So, but for those that did participate in the study, they will have a deeper dive. They will be the first ones to get the full report, which should be released in the upcoming weeks. They also will have access to a scorecard where we have, for all participants, put where they stand in 17 key metrics, of which we'll summarize those today. And it also compares the business to where they're at versus the average. And then also you have an idea of where the top 25% live in all those KPI. The other thing that will be available to participants is Rebecca Ezolt from our team will be available for one-on-one calls to take businesses through the scorecard, any particular insights, answer any questions. So we'll be setting up calendar links for people to sign up for a one-on-one. So our first duty and our first area of thanks goes to the participants. Without the participants, we don't have a study. So therefore, they're the ones that get the report first. They also get a scorecard, and they also can have a one-on-one to really unpack the findings. So with that, I prepared a presentation, and I'll serve as the play-by-play. And then Jared, feel free to jump in with any color commentary. Sound good?
Sounds great.
All right, so let's get started here. All right, so just to be clear, the 2025 Salon P&L Study, which includes data and insights on profitability, benchmarks, and industry trends, is performed by the Qnity Institute, which is the data division within Qnity. We have partnered in the Qnity Institute with Lightheart Sanders, CPAs. They are the ones that the P&Ls actually were submitted to. There was, to participate in the study, there was an upload of an actual P&L by an Excel document, usually exported from QuickBooks into Excel. And then Jared and his team went to great lengths to put that into some master spreadsheets, keeping every single company anonymous, and all of that. So again, really what we're looking at here is better data, better decisions, and better outcomes. Firm believers that with better data, you're able to create better outcomes because your decisions are based upon fact, not fiction, perception versus reality, or reality versus perception. And so our two areas of focus in the Qnity Institute are compensation and profitability. This is the second year in a row that we have performed this P&L study. So we've done it the last 2 years, and we are rapidly moving into collecting another year of data with some exciting efficiencies and technology that we'll save for another day. But let's go through just some macro findings from the study. We did have 61 companies from 13 states. And now, to give an idea here, there's no illusion that this is really representative of the entire industry. These are primarily premium salons, and we would say that multi-location is overrepresented compared to what the industry is. So keep in mind that our audience for the P&L study is really going to be primarily premium salons, even though it was open to salons of all sizes, even though we didn't do anything to sway participation. It just, this particular study tended to attract higher volume salons. So are these really applicable to the entire industry? I would say yes, but from a more specific standpoint, the data really is based upon submissions that are larger salons. So keep that in mind when we go through this. Let's get to the bottom line. BLUF, it's a new acronym. I actually have it. I just discovered this one. Bottom line up front. All right. So BLUF, here's the bottom line. So what we found is that the average net operating profit for this group of salons was 6.4%. Now, we also identify what top 25% would look like, and that would be measured by net operating profit. So throughout this presentation, when we refer to the top 25%, we're talking about a group of salons that really were in that top 25% of profitability based upon net operating profit. We really feel that this is the core indicator, because this is earnings from core operations before taxes, interest, depreciation, and owner's compensation. So we're going to give you two different profit numbers, net operating profit, which we'll call NOP. And then the next number I'm going to share with you is net income. Now, net income is bottom line. And this would be probably very close to what gets reported on a corporate tax return. We found that the average profitability was 3.2%. And the top 25%, as we can see, significantly outperform the average, with the top 25% sitting at net income of 10.5%. So this would be all income and expenses, including and factoring in owner's compensation, interest, depreciation, etc. Now, this number is actually down. Both of these numbers are down from the previous year's study. But I do want to create a little bit of a qualifier here, and Jared's been really good to point this out. So Jared, do you want to just give a very quick explanation around the makeup of the group in last year's study and then this year's study, and and how that could account for some of the variation?
Yeah, so this year's study, we had a higher percent of multi-location. participate. And so what that means is we're starting to see a real separation. I guess identifying specific places where multi-location differ from single location. And so the skew tends to be that multi-location as a percentage is less profitable than single location because you don't have some of the overhead of managing multiple locations and stuff like that. Single location can generally push and get a higher operating percentage. That doesn't mean that multi-location isn't more profitable, because you're having larger numbers. I mean, making 15% on $1 million versus making 10% on $2 million, you're still making more money. So it's not that multi-location itself is less profitable, but from a dollar coming in, the earnings percent tend to be a little bit tighter in multi-location. And so by de facto, by having more multi-location companies in this study versus last year's study is going to push those numbers down a little bit.
Okay, great. Thanks for the explanation. All right, let's move on to the next slide here, and we're going to break out just a little bit about the pool. And this will reinforce some of what Jared had mentioned. So we did have 61 participating companies, and of which 38 were multi-location and 23 single. The number of companies that were in both years, so they were in the 2024 and the 2025 study, was 45 companies. That's the best place to look at trends because you have apples to apples. And then the average size company, again, no illusion that this is for an average salon. The median revenue for the participant pool was 3.25 million. So definitely larger salons in this group. All right, let's start unpacking a little bit more of the numbers. And here's a framework that we really work off of when we do the report. When we did last year's report, I'm holding up on the screen right now. It was quite lengthy and it goes through everything in detail. We'll have a similar report coming out. And at the very beginning, we really create a structure for the report and how we produce the findings by, instead of looking at the P&L completely by all these lines and rows in a traditional P&L spreadsheet, is to really, cluster different costs and revenue. Well, cluster costs into 4 key areas: labor, products, space, and operating expenses. And then revenue sits by itself in the center. It has its own metrics. Ultimately, there's 17 different key performance indicators that came out of last year's report. It will come out of this year's report. There is 3 for labor, 3 for products, 3 for space, 3 for operating expense, and 3 for revenue. And then we have 2 different profit indicators. So unpacking this a little bit more, total labor, and this is service payroll, non-service payroll, payroll taxes, and benefits divided by total sales. It's not necessarily as commonly looked at in our particular industry, but it certainly is for the majority of other service-based businesses, and is something we probably need to look at a little bit more carefully. Now, we will break labor down into traditional service payroll divided by service revenue. We'll base, so we do have some of those metrics, but total labor divided by total revenue was right at 60%. Now, in a moment, we'll give you where the top 25% landed in a moment. Now, this is 3 times higher. I'm going to go by memory on this one. Bear with me a second. Yeah, almost 4 times higher than any other single category in your P&L. So this is where most of the opportunity and also where, performance lives so much is in labor. Let's talk about retail mix. So this would be retail sales divided by total sales. We found that the average for the group was just shy of 12%. Rent, we found that average rent was just shy of 7%. Revenue per square foot. This is an important indicator and something we've reported not only in this studies, but all the other P&L studies we've done over the years. For example, P&L studies done for the 2 to 10 project. We found that average revenue per square foot was $602 per foot. And then finally, getting back to profitability, we've already shown this number. So net income being 3.2%. Now, so for many years, people are blindly quoting profitability numbers without necessarily having data. But throughout the years, I've been saying 3 to 5%. And it turns out that this year's study was very close to 3%. And then the group from last year, which was a slightly different mix of companies, was closer to 5%. So is that a trend? It is a bit of a trend. We have noticed a decline in profitability between years. However, in looking at numbers very recently, we have seen a turn. We have seen a turn in profitability go in the right direction, especially as companies have really taken more proactive steps in the last 24 months to really reverse negative trends in profitability and find ways to increase profitability in spite of rising labor costs. All right, I'm going to take you through, Jared, is there any one of these? Well, actually, let me go to the next slide, and I'm going to go through the same specific numbers, but we're going to look where the top 25% sits. So, all right, total labor. We already mentioned the average is right at around 60%, 59.9. The top 25% is number in the bottom row, a huge difference. The top 25%, their total labor costs are running more in the neighborhood of 53.4%. I'm going to unpack that one in a little bit. Retail. We did not notice a difference between the top performers and the average in the group in retail as a percent of total sales. This is a similar finding that we had last year too, is that retail is not really turning out to be the X factor that is moving someone from into the top 25%. It's hugely meaningful in importance for profitability, but it's not necessarily the X factor. Rent, big difference in rent between the top performers and the average, really a full 1.5. And then finally, a couple other things here. Revenue per square foot, really big difference between the top performers and the average. You can see, it's a significant difference with the top performers being $769 and the average being $602. And then net income, again, this is a number, we're highlighting this again, a big difference, 3 times higher profitability between for the top performers. Jared, any of these numbers jump out to you that you want to comment on?
Sure. I think what we're saying is that when salons are first of all making good use of their space, right? Like recognizing and tying into that revenue per square foot is one that always kind of jumps out because it really is just saying how well your space is being utilized. And I think that kind of tends to blend into the labor cost side of things as well. So not only are the more profitable locations making more per square foot and really utilizing their space well, but they also tend to be managing their labor costs really well. And so you see those two combinations are what really tends to juice the last number, which is the profitability.
Perfect. Thanks, Jared. All right, let's look at a couple things now. Again, these are the top 25%, and this is a slightly different comparison. This is a comparison, a top 25%, not against the average, but against the other 75%. So a slight difference, but it's very similar story. If we look at net operating profit, again, about a 10-point difference with the top performers living at net operating profit of 14.8% versus 3 to 5% for the other 75%. If we look at total labor costs, a really significant difference. Top performers really, I mean, this is like a 10 to 12-point difference, which is huge. And that's straight to the bottom line. Rent and really dealing with space, which Jarrett was speaking about here a little bit ago. So about 2-point difference between the top performers and the other 75%. And then revenue per square foot, again, a really massive difference between the two. So what separates the top performers is an accumulation of small advantages, not one single lever. We found that the most profitable salons have several different KPI that fit well, but it's not like even for the top performers that, their P&Ls are performing above average in all categories. So some might be high in labor, but low in other areas. Some might be high in rent, lower in other areas. I will say that rent is something that has a carryover effect over many, many years, highlighting the importance of making really good space decisions before a lease or some type of change in space. All right. So on that note, we also looked at footprint and the average participant. Again, these are larger salons. And so footprint per location was right at around 3,500 square feet. What we found is the top 25% had smaller and leaner footprints, almost 25% smaller footprint, which makes intuitive sense that the top performers are going to have really great space utilization and maximize their space. So here are the average revenue per square foot, $602 versus $762 for the top 25%, which is about a $160 per square foot difference, which is 27% higher. I think we've already covered this one, Jarrett, so I'm going to move on.
Yep.
All right. What does not drive the profitability gap? One is retail mix. We mentioned that the average and the top 25% have almost identical retail penetration. We did notice that all the top performers had a meaningful amount of retail, but it wasn't like if a company had a very high percent of retail as a percent of total sales, that automatically put them into the most profitable category. So top performers are not necessarily out retailing the competition, and a lot of the edge in retail is going to come from gross margin. The other thing that didn't drive profitability was marketing spend. And we found that the amount of money spent on marketing was almost identical for the average and the top performers. Last year, we found that the top performers were actually spending a little bit less than the average, but there's no real meaningful gap on that one. Anything on either one of these, Jarrett?
No, I think that, when you look, especially like retail, we used to talk about, driving retail percent up would go immediately to the bottom line, but I think it runs into that space utilization and focus. I mean, the service is more profitable. And so it is a sweet spot though. Like you don't want to have lower, significantly lower retail, but you don't want to oversize and commit too much space to retail. So it is that balancing side. And I think it's one of those where we used to pay a lot of attention, but now it seems like getting to that point and just maintaining it seems to be the better approach.
All right. Now, interesting finding, if we look at the companies that participated both years, I mentioned earlier on that we did notice a drop in profitability. And in fact, we found that there was 70% of the companies had a decline in profitability between the 2 years. Again, we've seen that turn, but that was a significant percent. So for those of you that have felt the squeeze and are seeing your bottom line has declined, you're not alone on that. And again, I mean, that's a pretty significant percent, 70% showing a decline. So anything on that one?
Yeah, I mean, it just shows, and I think that we're just saying that, especially during those 2 years, that there was a lot of pressure. There's pressure from a salary perspective. Obviously, costs from an inflation standpoint really has put a lot of pressure on things. And I think we're seeing that just across the board in terms of reacting and adjusting and making those decisions. And now we're seeing kind of on the other side for this year that uptick.
So revenue grew 2.2%, but the margin did not keep pace. In other words, expenses went up higher than revenue. Now, as it relates to revenue, we're noticing for the second year in a row that all the revenue growth is coming from service and that retail continues to be in a multi-year decline. But net, there was growth, 2.2%. That seems to be the trend these days on, looking at some current sales data. We're continuing to see that revenue growing between 2 to 3%, but all of that really coming from service and retail continuing to decline. And then the other thing I wanted to mention about that was that I lost my train of thought. To be honest, in a live audience here, I lost my train of thought, but that's the key point there, is that revenue is going up on service and declining on retail. Now, we're going to look at the breakdown of the spend in a little bit here, but let's unpack labor a little bit and really where the gap really lives. And it's really the most consistent finding amongst all the different companies here. And the profit gap between the top 25% and the average as it relates to labor is a whopping 6.5 points. So total labor costs for the top performers were 53.4%, and the average spend was just shy of 60 at 59.9. So now that is that 6.5% is straight to the bottom line. And again, total labor costs include service payroll, non-service payroll, benefits, and payroll taxes. Now, for those of you that actually participated in the study, all of these numbers we have a deeper dive into. So how much comes from benefits, how much comes from payroll taxes and all of that. But we're doing really more of an executive summary today. All right. So let's look at total labor. We're belaboring this point here a little bit in terms of the gap between top performers and the average. And so I'm skip through that one, but let's look at service payroll versus non-service payroll. We found that the average service payroll actually jumped up a little bit to 46.9%, with the top most profitable salons having a lower spend, 43.2. And this includes assistants. It's net of service charge. It's regardless of whether it's commission, hourly, or salary. This is really service payroll divided by service sales. And again, it includes assistants, excludes payroll taxes and benefits. Now, one of the things that we did notice, we don't really take a position on pay system. But we did find that none of the top performers were salary or hourly, but rather 100% of the top performers were commission. And that was consistent with last year's study too. So again, we don't really take a position on method of pay, but we did find that all of the top performers were commission, and we could not find any salary or hourly that were in that upper percent. And that's been a finding that we also saw in previous years when we would do studies from the 2 to 10 project. Non-service payroll, the average, which is jumping up a bit, was 12%, with the top performers spending a full 2.2% lower. And this is managers, admin, front desk, function leads, anybody that's not providing services. We did do our best to remove owner's compensation, and owner's compensation we're isolating as other expense below net operating profit. Now, the gap between service payroll and non-service payroll for top performers is much wider in non-service payroll. From a percentage standpoint, well over twice as impactful, and non-service payroll is definitely more controllable and where we've seen a lot of profit improvement over recent months in the last year. Jared, anything on labor? Anything else?
I mean, I know that well, for a lot of our conversations and discussions, it's, you have that balance of service providers pushing for higher compensation percentages and stuff like that. Um, there's probably two things that I would think about in terms of that top 25 versus the average and balancing that out. Part of that, I think you could go through and say there's lots of ways to help providers understand and make more money without necessarily increasing the percentage. On the non-service payroll, I think the biggest thing is just that focus of understanding your non-service payroll and how much of a chunk it's taking away, and really trying to tie those positions back into making sure that the profitability supports the volume that you have. And so having a good look at those and just maintaining them, but being aware, like if a company is bringing less it's really easy for that non-service to kick up and become a higher percentage and really eat away at your profits.
Great, thanks, Jared. So here is the breakdown of a dollar. And this was the group, last year's group. And what I'm going to do is show you where the change is. So labor went from 58 cents. So let me back up a little bit. So really what this graphic is intended to do is show that for every dollar coming into the business, how much is spent, where it's spent, and what's left in profitability. We noticed that labor went up by a full 3 percentage points. Operating expenses and space stayed about the same. Products actually went down. But a big reason for that is the declining mix of revenue. So as retail revenue declines, the spend will decline also. So this isn't necessarily a spending efficiency. It more has to do with the mix of business. So this is really an interesting indicator to just zoom back out and say, where's all the money going? And where's the trend and all of that? Anything on this, Jared?
Yeah, I mean, I think you nailed it. Like when you look at it, the more that you increase your revenue um, on the service side, it by nature is growing faster than the product side is, which is normal, and so that plays into it. The other thing would be just in terms of single versus multi-location, because this is based on the study. So all participants really push that up, and again, that's That is affected some by the fact that multi-location tend to have a little bit higher labor costs versus single. And so there is a little bit of a gap there. And so from the study standpoint, it's being pushed not only by the fact that labor is increasing in cost, but also because the mix of participants is pushing it a little bit too.
Excellent. Thanks, Jared. All right, so here's some key takeaways. So revenue growth is not enough. The cohort group, 2.2% in revenue, but 70% still saw a decline in net operating profits. So volume without margin management erodes profitability. Another key takeaway is that service pay rates are relatively flat between year to year. The cost creep is coming up more in non-service payroll, benefits, and operating expenses. And then finally, another insight and takeaway is it's winning through accumulation. So labor, rent, retail discipline near 12%. It is a compounding advantage that the top performers really have to create like a winning P&L. So now, one of the things that we've been working on with clients and other members of our community is in many cases, the business knows what to do. And the question is taking action on it. And, it's one thing to be able to line your P&L up to benchmarks or a scorecard and say, okay, this is a gap here. We need to do something about it. Change management and how you make the change is really a big focus that we've had. And it's going beyond the data and the insights into action. And so, and really moving from perception into reality as you're trying to create a more profitable business. So data insights and action, data and insights are great. And so action is really, again, something we've been focusing on. We did do a group in the first quarter. It was really inspired by going through several of last year's participants. And they're like, boy, our profitability really need to work on it. Right now we're at 4%. We want to be at 10%. And, so everybody really, for the right reasons, wants to and needs to focus on profitability. And we said, well, it's one thing to double your profitability. And we do think that's possible. We've seen companies double their profitability through a lot of the right action, as well as some, positive changes that have come through price increases, right sizing labor, et cetera, et cetera. But we said, rather than setting this massive goal of doubling your profitability, what if you could just get one more point? So what if you are at 5% profitability today? What would it look like to get to 6% profitability? Well, that's a full 1 percentage point, but it's also a 20% increase in profitability. So we worked with a cohort group for over 3 months, and it was absolutely remarkable the changes that were made by many of these companies once they put some focus on this, and they really came up with what we feel is a more reasonable target. And that's really the focus for a lot of the work that we're doing right now. Again, better data, better decisions, better outcomes. And I am going to put a QR code up on here for those of you that want to be involved in future studies. You want to get the report. You want help on profitability. So here's that QR code. We are beginning very soon collecting another year of P&Ls. And we also are going to be doing a non-service payroll study. So we certainly hit the QR code if you're interested in either one of those. It's really important. The more companies we have in our profitability and labor studies, the better results, the better for the industry. And so we'd like to encourage participation. The other thing is, again, for those that have participated in this year's study, watch for an email that would include a meeting invite as well as your scorecard. And then you'll also get a copy of the report. So that's what we have for you guys today. And let me just see if there's any comments. Yeah. Yep. Okay. Thank you for, yep, I'm seeing some comments here. And thanks for the comments. Yeah, appreciate us doing it. We're the only ones who've been torturing ourselves over a dip in profitability. Don't torture yourself. And I'm seeing some really positive trends right now. And I'm seeing some companies that aren't just finding a point, but they're finding 2, 3, 4 points, and it's super exciting. But it does come through some work. It does come through intention, and we're pleased to help you in any way we can. And Jared, I did want to give you a big shout out. Thanks for all the work you've done. It's a lot of nights and weekends. It's over and above your day job, and we could not do this without your help. So bravo to you. Thank you. So.
Thank you, Tom. You know, something that Candace said, I think 3, 4 years ago about the disciplined pursuit of profitability has really kind of rung true. And I think that that's it. There's so many different ways to improve your numbers, whether it's increasing revenue, whether it's decreasing costs and stuff like that, that it does take first getting good numbers, but then second, like attacking them and asking, how can we do better?
Excellent. All right, folks, we will see you in 2 weeks. Happy June. Let's end the first 6 months of the year super strong. And we will continue to dig deeper into the numbers. We do have some exciting things coming up on the data side. We've got some new technology coming in that's going to make the process be more efficient, easier for you to get the results and all of that. So this is really a relentless pursuit of getting good data so you can make better decisions and have better outcomes. So all the best, everybody, and we'll see you soon.